This is a moment that caught the entire financial world off guard. In just 3 hours, the global gold market experienced one of the fastest intraday collapses in recent history. Gold plunged from roughly $5,150 down to nearly $4,980 per ounce, erasing about $180 in value almost instantly. At the same time, silver dropped sharply from $102 to around $90, while Bitcoin slipped towards $79,000 as investors across global markets suddenly shifted into a defensive risk-off mode. The combined impact of these moves erased an estimated $2 trillion in market value across precious metals, crypto, and broader financial assets in a very short window. What makes this event especially important is not just the speed of the price move, but the context in which it happened. Gold had recently been trading near historic highs, supported by strong central bank demand, persistent inflation concerns, and rising geopolitical tensions around the world. Many investors believed the rally in precious metals was entering a new phase of structural strength. Yet within hours, the market experienced a violent reversal triggered inside the futures trading system. Margin increases by the CME exchange forced leveraged traders to rapidly liquidate positions, causing an avalanche of selling in the COMEX derivatives market. But here is the surprising twist. While paper prices collapsed in the futures market, the underlying physical demand for gold remained strong, and inventories stored inside COMEX vaults have continued trending lower. This raises a critical question for investors and analysts watching this event unfold. Was this sudden crash the beginning of a deeper correction in the metals market, or was it simply a mechanical liquidation event caused by leverage and margin pressure? Understanding the forces behind this crash is essential because the gold market is not just about metals. It reflects the deeper structure of the global financial system itself. At first glance, a sudden drop in gold prices may seem like a niche event affecting only traders or commodity investors. But the truth is that gold sits at the center of the global financial system in ways most people rarely consider. Gold is not just another commodity like copper or oil. For thousands of years, it has served as a store of value, a reserve asset, and a hedge against financial instability. Today, central banks, pension funds, sovereign wealth funds, and millions of individual investors around the world hold gold as a form of financial insurance. When gold suddenly drops nearly $180 in a matter of hours, it sends a signal through multiple layers of the global economy. Financial markets interpret such moves as changes in liquidity conditions, leverage levels, and investor risk appetite. That is why the same moment that gold fell sharply, other markets also reacted. Silver plunged more than 10%, Bitcoin retreated towards $79,000, and volatility across global asset classes began to increase. These correlations reveal something deeper happening beneath the surface. Investors were rapidly reducing exposure to risk. This matters for everyday people as well. Large institutional investors often use gold as a hedge against inflation, currency weakness, and financial crises. When the gold market experiences sudden volatility, it can influence how institutions allocate capital across stocks, bonds, and currencies. In other words, events in the gold market can indirectly affect retirement portfolios, government policy decisions, and global financial stability. The stakes are even higher because we are currently operating in a world of elevated debt levels, fragile supply chains, and persistent geopolitical tensions. In such an environment, gold is more than just a metal. It is a barometer of confidence in the financial system. When it moves violently, investors pay attention because it may signal deeper structural stress developing beneath the surface of global markets. To understand how such a dramatic collapse unfolded so quickly, we need to examine the exact sequence of events that triggered the sell-off. The gold market entered the trading session with strong momentum. Prices had recently climbed toward $5,150 per ounce, supported by weeks of bullish sentiment driven by inflation concerns, central bank buying, and geopolitical risk. Traders across futures markets were heavily positioned on the long side, expecting the rally to continue. Then a key development occurred. The Chicago Mercantile Exchange, CME, which operates the COMEX gold futures market, announced an increase in margin requirements. Margin is essentially the collateral traders must deposit to hold leveraged futures positions. When exchanges raise margin requirements, traders must either add more capital to maintain their positions or reduce exposure. In highly leveraged markets, even small changes in margin requirements can trigger massive forced selling. As soon as the margin increase took effect, leveraged funds and speculative traders began liquidating positions. The selling started gradually but quickly accelerated as automated trading systems detected the downward momentum. Stop-loss orders began triggering across trading platforms, amplifying the decline. Within minutes, gold broke below key technical support levels around $5,050 and $5,000, causing even more selling pressure to to enter the market. The result was a rapid cascade of liquidations. Futures contracts were dumped into the market faster than buyers could absorb them. This is why the price collapsed so dramatically in such a short period of time. Meanwhile, other markets began reacting as well. Silver followed gold downward, dropping from $102 to $90, while Bitcoin slid towards $79,000 as investors across asset classes reduced exposure. What started as a margin adjustment in the futures market quickly became a broader global market shock. Although the trigger was a margin increase, the deeper cause of this crash lies in the structure of modern financial markets. Today's gold market is dominated not by physical metal trading, but by derivatives and futures contracts. These financial instruments allow traders to control large amounts of gold using relatively small amounts of capital. For example, a trader may control a gold futures position worth $500,000 while posting only a fraction of that value as margin. This leverage creates a powerful amplification effect in the market. When prices move in the trader's favor, profits can be large, but when prices move against leveraged positions, losses can accumulate extremely quickly. When margin requirements rise, leveraged traders are forced to either add more capital or exit their positions. If many traders face the same pressure at the same time, liquidation cascades occur. This is exactly what appears to have happened during the recent gold crash. Hedge funds, algorithmic trading systems, and speculative investors were heavily positioned in the same direction after the recent rally. When the market turned, the unwinding of these positions created a self-reinforcing downward spiral. Each wave of selling pushed prices lower, triggering additional stop-loss orders and margin calls. Importantly, this process occurs largely inside the paper derivatives market, not in the physical gold market. That means the price of gold can move dramatically even if the underlying supply and demand for physical metal has not changed significantly. Understanding this distinction is critical. The recent crash was not necessarily caused by a sudden collapse in demand for gold. Instead, it appears to be the result of financial leverage interacting with automated trading systems, creating a temporary but powerful shock to the market. While market charts and price data often make financial events seem abstract, the reality is that sudden market shocks can have very real consequences for people and businesses. When gold drops nearly $180 in just a few hours, traders holding leveraged positions can experience enormous losses almost instantly. Hedge funds and commodity trading firms that entered the market expecting continued gains may suddenly find themselves facing margin calls from their brokers. If they cannot provide additional collateral quickly enough, their positions are automatically liquidated, locking in losses. Individual investors can be affected as well. Many retail traders participate in gold and silver markets through leveraged exchange-traded products or derivatives. These instruments magnify both gains and losses. During rapid price moves, retail investors often find themselves caught in the same liquidation cycle that affects large institutions. Businesses involved in the precious metals ecosystem also feel the impact. Mining companies, refining firms, and bullion dealers often hedge their production using futures contracts. Sudden price swings can disrupt hedging strategies and create uncertainty in forward planning. Jewelry manufacturers and industrial buyers may delay purchases during volatile periods, temporarily slowing demand. Even companies outside the metals industry can feel indirect effects. Financial market instability can tighten credit conditions, influence currency movements, and affect global investment flows. The interconnected nature of modern financial markets means that a shock in one asset class can ripple outward across multiple sectors. This is why analysts pay close attention to sudden moves in gold and silver markets. These events are not just isolated trading anomalies. They can signal broader shifts in investor behavior, liquidity conditions, and economic confidence. The recent gold crash is unfolding against a backdrop of broader financial pressures that are already affecting global markets. One of the most significant of these pressures is the current environment of tight monetary policy and elevated interest rates. Central banks around the world have spent the past several years attempting to control persistent inflation. To achieve this, many have raised interest rates and reduced liquidity within financial systems. While these policies are intended to stabilize prices, they also increase the cost of borrowing and reduce the availability of easy capital. In leveraged markets like futures trading, tight liquidity can amplify volatility. When interest rates are higher, maintaining leveraged positions becomes more expensive. Investors become more sensitive to margin changes and market fluctuations. This environment makes sudden liquidation events more likely. At the same time, government debt levels in many advanced economies remain historically high. Servicing that debt becomes more challenging as interest rates rise. This dynamic creates a delicate balance for policymakers. On one hand, they must control inflation. On the other hand, excessive tightening could destabilize financial markets or slow economic growth too aggressively. These pressures are already influencing investor behavior. Many institutional investors are adjusting their portfolios to manage risk in a more uncertain economic environment. When unexpected events occur, such as the sudden margin increase in the gold futures market, the reaction can be amplified by this broader backdrop of financial caution. In other words, the gold crash did not occur in isolation. It took place within a global system already experiencing elevated levels of stress and uncertainty. Another important factor shaping the current environment is the growing instability within global currency markets. Over the past decade, major economies have relied heavily on monetary expansion to support growth during crises. This has increased the total supply of currency circulating within the global financial system. While such policies can stabilize economies during emergencies, they also create long-term challenges. When investors begin to question the stability of major currencies, they often turn toward alternative stores of value such as gold. This trend has become particularly visible in recent years as central banks, especially in emerging markets, have increased their gold reserves. Countries seeking to diversify away from traditional reserve assets have accelerated gold purchases, contributing to strong long-term demand. However, currency volatility can also create short-term turbulence in financial markets. When exchange rates fluctuate rapidly, global investors often rebalance portfolios to manage risk. These adjustments can trigger large capital flows between different asset classes. In periods of heightened uncertainty, markets can become extremely sensitive to new information. News about monetary policy, geopolitical developments, or economic data can quickly alter investor expectations. The recent gold crash may partly reflect this fragile environment. When the margin increase triggered selling pressure in futures markets, investors across the world were already positioned defensively. This amplified the reaction and allowed the price decline to spread rapidly across related markets. Silver followed gold downward, while Bitcoin and other risk assets also weakened. Such synchronized movements suggest that investors were responding not just to one market event, but to a broader perception of rising financial risk. The implications of this event extend beyond traders and financial institutions. Gold plays an important role in national economic strategies and central bank policies. Many governments hold significant gold reserves as part of their official assets. These reserves serve as a form of financial security, particularly during periods of currency instability or geopolitical tension. When gold prices experience sudden volatility, it can influence how policymakers evaluate economic conditions. Central banks monitor gold markets closely because the metal often reflects investor expectations about inflation, interest rates, and currency strength. A sharp decline in gold can sometimes indicate tightening financial conditions or reduced demand for safe haven assets. However, if the decline is driven primarily by futures market mechanics rather than fundamental changes in demand, policymakers may interpret it differently. In the current situation, physical gold demand remains relatively strong in several regions of the world. Asian markets, particularly China and India, continue to show robust retail and institutional interest in precious metals. This suggests that the underlying demand for gold as a store of value remains intact. Governments also watch gold markets because of their relationship with currency stability. In times of financial stress, rising gold prices can signal declining confidence in fiat currencies. Conversely, sudden price drops may reflect shifts in liquidity conditions or investor sentiment. The recent crash, therefore, represents more than just a trading event. It is part of a larger dialogue between markets, governments, and central banks about the stability of the global financial system. Looking forward, the most important question is whether the recent gold crash represents a temporary liquidation event or the beginning of a deeper structural change in the market. Financial history shows that sudden price collapses are often followed by periods of stabilization as markets absorb the shock and reassess underlying fundamentals. In many cases, such events reveal weaknesses in the structure of leverage trading systems rather than fundamental changes in long-term demand. The gold market is currently at a crossroads. On one side, the derivatives-driven futures market can generate extreme short-term volatility through leverage, algorithmic trading, and margin adjustments. On the other side, the physical gold market continues to show steady demand from central banks, institutional investors, and retail buyers. If physical demand remains strong while futures markets experience repeated liquidation events, the divergence between paper prices and physical supply could become an increasingly important factor. Some analysts believe this dynamic may eventually lead to structural changes in how precious metals are priced globally. At the same time, investors must remain cautious. Markets driven by leverage can remain volatile for extended periods. Additional margin changes, shifts in monetary policy, or new geopolitical developments could trigger further price swings. The key lesson from this event is that modern financial markets operate within complex systems where leverage, liquidity, and psychology interact continuously. For investors, the best response is not panic, but awareness. Understanding the mechanisms behind these moves allows participants to interpret volatility more clearly and make decisions based on long-term fundamentals rather than short-term fear.